Hey, this is Chris, the Mortgage Pro. Today I'm going to teach you how to qualify for a mortgage. Well, there's a lot of things, obviously, that a lender has to look at. So let's go through each and every one of them. The first one that stops everybody and they get all nervous is credit. Now, some people have outstanding credit. And some people, hey, they have challenges. Maybe they had late pays. You know, bad things happen to good people all the time. And sometimes that's the reason for a low credit score. Sometimes it's you don't even have enough credit. So let me give you a way to think about how the lender will look at your credit. They say to themselves, hey, if this guy can't pay a $25 a month credit card, why are we going to lend him $300,000? It's a small way of thinking. Don't think small, though. Think bigger. Think, I'm not going to go out to dinner. I'm going to pay my bills. First, you pay your bills. This is what my mama taught me. First, you pay your bills, you pay the mortgage, you pay all your other debts. Then you figure out, are we eating steak or we're eating beans? It's just a way to think. If you think like that, in a short period of time, your credit's going to be good enough to fire your landlord. Okay, next thing, lender needs to know income. Well, do you have job stability? How long have you been on your job? Look, you could get a job and get approved the next day. You really can. But if you change jobs every 3 months, well, that job stability isn't there. They want to see some kind of stability. Do they want to see income? Of course. How do they know that you can afford to make that payment? They need to know that you have the income. They expect it to continue for usually 3 years is what they're looking for. Obviously, you can get fired, you can get laid off, things could change, but they have a reasonable expectation of 3 years going forward that the income will continue. So they want to see that. They'd love to see a history. The stronger the history, the stronger the case that you could fire your landlord. Okay, next thing they want to see. Down payment. They call this skin in the game. If you put up your own money that you worked hard for a down payment, they say, hey, they got some skin in the game. They're serious. They're committed. Now, if you put a zero down program, and we have these zero down programs, they work great for some people, but it makes it a little bit tougher for the underwriter to say, yeah, they're worth taking a shot on. So we want to see a down payment. Sometimes people put $200,000 down on a $400,000 house. Do they have some skin in the game? It makes the underwriter's decision way easier, doesn't it? And if a person can't put $1,000 or $2,000 down, it makes the underwriter a little nervous. So take advantage of the programs, save some money, but be sure that you're ready to show you're committed to this transaction. Okay, something else obviously the underwriter wants to see. We need an appraisal of the property. We have to know, the lender needs to know that if it's a $400,000 loan, that the house isn't worth $350,000. So the collateral is the last piece of the puzzle that they have to make sure it's worth it. But that also protects you as the borrower. Why? Because if you commit to buying a house for $400,000 and it appraises at $380,000, is that something you really want to do? So this is designed to protect you and protect the lender. That's a big deal. Okay, not only do they want to see your credit, but on the credit report, it's a list of debts. What do you mean? Well, you have your car payment on there. You have your credit cards. You may have child support, alimony. We have to look at all the debts. If you make $5,000 a month, but you have $2,000 a month in debt, doesn't leave a whole lot for a house payment. So we have to look at all the numbers versus your income. So that's the last thing that they're going to want to see, how much is going out already, because you're going to add on this new house payment. Okay, so those are the 5 things that a lender needs to see. They want to see your credit. Are you responsible? Do you pay your bills on time, or do you make excuses for not paying them? Do you have crazy debt that's out of control that you can't handle when you add on a house payment? Do you have income and job stability? How's that going? Do you have 5 new jobs or 1 new job? Doesn't really matter if you have 2 or 3 jobs, but if you change your job on a regular basis, not going to work. What else? They want to see how much money you've saved. What's in your 401k? What's in your IRA? What is in your bank? Do you save money? Do you have a financial responsibility that you are showing you are a responsible borrower? Those are the things they want to see. And obviously, the appraisal. They want to make sure the collateral is solid and it protects the lender and protects you. So this is Chris Trapani. Call me. I'll help you figure it out. And together we're going to fire your landlord.